You know how crypto can often feel like the digital Wild West?
Oh, absolutely. Vast, untamed.
Exactly.
Yeah.
A frontier where innovation runs wild, but the rules are, let's just say, still being written.
Mm-hmm. Definitely catching up.
Well, buckle up because the sheriffs are riding in. And they're not just bringing badges, they're bringing a whole new rule book. What you thought you knew about digital assets might be about to fundamentally change forever. Today, we're taking a deep dive into how the Commodity Futures Trading Commission, the CFTC, is leading a charge that promises to reshape the entire crypto landscape. We're going to unpack the surprising facts behind this regulatory revolution.
It's a huge shift.
It really is. Our mission today is to unpack all these immense complexities, trying to demystify some of the jargon,
Yeah, there's a lot of it.
and reveal the truly profound shifts driven by the CFTC's crypto sprint, especially as it coordinates with the SEC and some pretty groundbreaking new legislation. We want to make sure you're not just informed, but genuinely well-versed in what this new era means for the future of digital assets and, your place within it.
And to give you that full picture, we've cast a really wide net for our sources. This isn't just based on one press release. We've pulled insights directly from the regulators themselves, the CFTC and SEC, their official statements. But we've also delved into detailed analyses from some really respected legal firms in the space. Think DLA Piper, Latham and Watkins, Wilkie, Gibson Dunn.
Haters.
Exactly. And to make sure we capture the broader market sentiment, different perspectives, we've even incorporated views from prominent commentators like CoinDuero. So it isn't just one viewpoint. It's more like a rich tapestry of insights. What's fascinating is how much convergence there is, signaling this unprecedented shift.
Okay, let's try and unpack this using the Feynman technique. We'll break down each concept into its simplest terms, highlight what we still don't fully know, those crucial knowledge gaps you'll want to keep an eye on.
Important to know what we don't know.
Totally. And we'll use some clear, relatable analogies to try and make sure every piece of this kind of intricate puzzle clicks into place for you. And remember, things are moving at breakneck speed. It's August 23, 2025, right now.
Yeah.
And we're seeing announcements and developments from just weeks ago, even days. The regulatory landscape for crypto is literally transforming before our eyes. When you hear the current administration's vision, this really ambitious goal to make America the crypto capital of the world, it sounds like more than just a catchy phrase.
Oh, it definitely is.
It feels like it truly sets the stage for everything else we're seeing. What makes this vision so pivotal for the entire regulatory landscape? Why is that statement so important?
It's because it carries immense strategic weight. This isn't just a political talking point. It's a comprehensive directive. To actually make this happen, the President's Working Group on Digital Asset Markets published a foundational report earlier this year, back on January 31st.
Okay.
And this wasn't just like a suggestion box, it was a blueprint. It laid out strategic priorities for the U.S., aiming to foster innovation and leadership in digital assets, blockchain tech. What's really compelling is that the report acknowledged the huge growth of the digital asset ecosystem, crypto, stablecoins, DeFi.
All of it.
Right. And it called for Congress and federal agencies to clarify the legal status of digital assets, to enable federal-level trading, and crucially, to ensure banking regulations are technology neutral. That signaled a mature understanding that, a fragmented reactive approach just wasn't going to cut it anymore.
Right.
The goal is really to create an environment where innovation can thrive within defined, safe parameters instead of being stifled by uncertainty, which, let's be honest, has been the story for way too long.
So, into this rapidly evolving scene steps the Commodity Futures Trading Commission, the CFTC.
Yeah.
It's genuinely fascinating that they're so often seen as the crypto-friendly regulator, especially given how complex these assets are. From your perspective, what is it fundamentally about the CFTC's mandate, or maybe their operational philosophy, that fosters this perception, especially when you put them next to the SEC?
Yeah, it really boils down to their core mission and the kinds of markets they've historically overseen. The CFTC's job, in simple terms, is to oversee U.S. derivatives markets, think futures and options contracts that are tied to commodities.
Okay, commodities.
Right. And they also have a crucial enforcement role over fraud and manipulation in commodity spot markets. And a spot market, just for everyone listening, is where you buy or sell an asset for immediate delivery right now, as opposed to a contract for delivery way off in the future.
Got it.
Now, the key difference and what makes them seem more friendly to a lot of folks in crypto is their sort of philosophical starting point. Let's use that ocean analogy again. Imagine crypto markets as this vast, maybe largely uncharted ocean.
Okay.
The SEC traditionally patrols the shipping lanes for the passenger cruise ships. Those are the securities. Their main concern is making sure tickets are sold properly, disclosures are right for investors, passengers are safe. They're really focused on the initial offering and the whole investment contract aspect.
Like, is this a security offering?
Exactly. Is this a cruise ship ticket being sold correctly? The CFTC, on the other hand, is responsible for the fishing fleets and the cargo ships. Those are the commodities and their related derivatives. Their job is to ensure fair trading, prevent price manipulation, oversee the integrity of the markets where these raw materials are traded, even if it's just a spot check on the dock for an immediate transaction.
So less about the initial sale, more about the ongoing trading.
Precisely. While the SEC is deeply concerned with how a digital asset is offered and if it constitutes an investment contract, the CFTC is more focused on the trading behavior around assets it considers commodities. Especially when leverage or margin gets involved, they want to prevent market manipulation. So, this difference in focus often makes the CFTC's existing framework seem more adaptable to digital assets, which often trade like commodities. They're less worried about what it is initially and more about how it's being traded in the secondary market.
And it's not just a perception thing, is it?
Mm.
The CFTC has a track record, a documented history of what many people call predictable, innovation-friendly oversight. I mean, they already oversee significant derivative activity for major cryptos like Bitcoin, Ethereum, Solana, XRP on big regulated exchanges like the CME, the Chicago Mercantile Exchange.
Exactly.
So when it comes to derivatives, they're not new to this game. They've been doing this for a while, providing some level of comfort and established rules for those specific products.
That's right. And a key part of that innovation-friendly approach is their streamlined self-certification process for new contracts. Under CFTC rules, exchanges can, in many cases, just self-certify new product listings.
Self-certify, meaning they don't need explicit pre-approval every single time.
Pretty much. It allows new products to go live relatively quickly, usually within a 90-day review period, unless the CFTC actively steps in to block it. This offers, simplicity, speed, clarity, which is a huge draw for crypto entities wanting to launch new derivative products. It cuts down the waiting time, the bureaucratic friction. That's incredibly attractive in an industry moving as fast as crypto.
Yeah, you can see why that'd be appealing. And it stands in such stark contrast to the SEC, which, especially under past administrations, was definitely perceived as, well, more hostile to crypto growth. It led to a lot of uncertainty, a lot of frustration.
Absolutely.
But even the SEC seems to be shifting its stance now, aligning with this new administration's vision.
And this is where Project Crypto comes in. It really marks a profound pivot for the SEC. Launched by its new chair, Paul S. Atkins, just on July 31st, 2025, this initiative is nothing short of an ambitious overhaul.
Okay, Project Crypto, what's the core idea?
Project Crypto aims to fundamentally modernize how the SEC handles digital assets. The focus is on creating clear, practical rules for things like crypto asset distributions, custody, trading. It directly aligns with the president's vision to make America the crypto capital by facilitating the onshoring of crypto businesses, bringing them back after they might have left due to that regulatory uncertainty.
Right, bringing them home.
And what's really compelling here is the emphasis on interagency cooperation. Acting Chairman Thom of the CFTC herself said they will work closely with SEC Chairman Paul Atkins and Commissioner Hester Pierce to achieve Project Crypto.
So they're actually talking to each other now.
It sounds like it. It underscores this collaborative effort. This isn't just minor tweaking. It's an intentional effort to finally end that era of ambiguity.
Okay, so with these two major regulators seemingly on a new, more collaborative path, what does this actually mean for you, the individual interested in, or maybe already invested in, digital assets? This brings us right to our first big knowledge gap question. What exactly distinguishes a crypto commodity from a crypto security in the eyes of these regulators? And why does that distinction matter so critically for both innovation and consumer protection?
It's been the million-dollar question forever.
It really has.
From your perspective, what's the simplest way for our listeners to truly grasp this core difference?
Okay, at its heart, for the SEC, it often comes down to the Howey test. It's been the legal standard for decades.
Right, the Howey test.
The Howey test basically asks, is there an investment of money? Is it in a common enterprise? Is there an expectation of profits? And crucially, are those profits to be derived from the efforts of others? If the answer to all that is yes, like buying shares in a company or investing in some new venture, hoping a specific team makes it valuable, then it's likely a security under the SEC's watch.
So, relying on a team to make you money. Exactly. The SEC's focus is on protecting investors from fraud or misleading offerings, making sure there are adequate disclosures so people can make informed decisions before investing. But if it's more like owning a fungible resource, something, like digital gold, maybe digital oil, or even a decentralized system built purely for utility, where its value is driven mainly by supply and demand, network effects, its inherent usefulness, rather than a specific management team promising returns.
Oh, okay.
Then it tends to fall under the CFTC's commodity umbrella. The CFTC is more concerned with the integrity of the market for that asset, preventing price manipulation, ensuring fair trading practices.
So the source of the potential profit is key.
It really is. The distinction is absolutely vital because it dictates entirely different rule books. One focuses on investor disclosures for buying into a venture, the other on fair trading in the market for a raw material or resource.
So that phrase, the efforts of others, is truly the linchpin here.
It often is.
If an asset's value is mainly tied to a core team's promises or active management, generally SEC territory. But if it's more like a decentralized digital resource, traded openly based on utility and market forces, it lands with the CFTC.
That's a great simplification.
Okay, that helps simplify a notoriously complex legal question. And it underscores why this regulatory clarity they're aiming for is literally game-changing for builders, investors, everyone.
Now, before this recent crypto sprint really kicked off, the CFTC was primarily using its existing authority under Section 2C2D of the Commodity Exchange Act, the CEA. This section basically lets the CFTC regulate certain leveraged retail commodity transactions as if they were futures contracts, unless specific exceptions apply.
Okay, so treating leveraged spot trades like futures sometimes.
Kind of, yeah, for retail customers. And one of the key exceptions is the actual delivery test. Back in March 2020, the CFTC put out guidance clarifying that actual delivery means the customer has secured a meaningful degree of possession and control over the virtual currency within 28 days.
Meaningful control. What does that mean practically?
It means the seller has delivered the entire purchase, including any part bought with leverage, and the buyer can freely transfer it, move it, use the full amount without any liens hanging over it beyond that 28-day window. This guidance set a really crucial precedent for how the CFTC viewed certain types of crypto trading, aiming to protect retail folks from what basically amounted to off-exchange, unregulated leveraged trading.
And this actual delivery test became pretty central in some significant cases, right? Like the one against Kraken back in 2021.
Exactly. Kraken was running a platform allowing retail customers to trade digital assets on margin. The CFTC found that Kraken didn't meet that actual delivery exception because Kraken kept possession and control of the margined assets.
So the customer couldn't just take their margin crypto and walk away?
Precisely. Customers couldn't freely use those assets away from Kraken's platform until they'd paid back the margin, and Kraken was the sole provider of that margin. So this case clearly showed the CFTC was willing to step in when platforms facilitated what looked like off-exchange futures trading, even if it technically involved spot assets.
Because the mechanics, the leverage, made it function like a derivative.
Right. The customer didn't truly control the underlying commodity. It brought them firmly under CFTC jurisdiction. It was a clear signal. Just because it's crypto doesn't mean it's a regulatory free-for-all, especially with leverage for retail.
Gotcha.
And building on that, the B0X LLC Uki DAO case in September 2022 that further showed the CFTC's reach, particularly into DeFi, decentralized finance.
Uki DAO, right. What happened there?
This involved a blockchain-based protocol, the BZX protocol. It enabled off-exchange, leveraged, and margined retail commodity transactions using smart contracts on Ethereum. Traders could post collateral, like ETH, to open leveraged positions, borrowing other cryptos from liquidity pools.
The big claim, the allure, was its decentralized nature, supposedly letting customers do this without a third-party intermediary holding their funds.
Sounds very DeFi, so
Yeah.
no central company involved. Well, the CFTC didn't quite see it that way because B0X, the entity initially behind the protocol, wasn't a designated contract market, a DCM, that's a CFTC-registered futures exchange. It was found to be violating the CEA. This showed the CFTC's willingness to reach even into supposedly decentralized protocols when they touch U.S. retail customers in these leveraged contexts, especially if they're not on a regulated exchange.
So decentralization isn't an automatic shield?
Not according to the CFTC in this case. Their view was, even if custody was decentralized, the transaction itself offering leveraged commodity trading to U.S. retail without registration still fell under their authority. It was a potent message to the DeFi world.
Okay, so the CFTC was already flexing its muscles pre-sprint. Meanwhile, on the SEC side you mentioned, we've seen signs of that broader shift in approach too.
Yes, definitely. Enforcement actions that once seemed, inevitable or destined to drag on forever are being reevaluated or even dismissed under the new leadership.
Like the Coinbase case. That felt huge.
Absolutely huge. The dismissal of the SEC's civil enforcement action against Coinbase on February 27, 2025, was a major development. This came after an earlier court ruling in March 2024 had actually largely favored the SEC, finding plausible allegations that certain tokens and Coinbase's staking services were securities, and that Coinbase was acting as an unregistered broker, exchange, and clearing agency.
So the tide turned quite dramatically.
It really did. This dismissal under the SEC's new leadership signals a significant recalibration. It suggests a move toward establishing clear regulatory frameworks first, like Project Crypto aims to do, rather than relying solely on enforcement actions to define the rules of the road after the fact.
Less regulation by enforcement, more regulation by framework.
Exactly. It's a move to reduce that ambiguity that's plagued the industry, and yeah, a substantial win for Coinbase and the broader U.S. crypto space.
And it wasn't just Coinbase, right? There was also that NFT case involving Nathaniel Chastain.
Right. On July 31st, 2025, the Second Circuit Court of Appeals vacated Nathaniel Chastain's conviction. He was a former OpenSea employee convicted of wire fraud and money laundering for basically trading NFTs based on inside info about which collections would get featured on OpenSea's homepage. Kind of like NFT insider trading.
Okay, so why was the conviction overturned?
The appeals court found that the lower court gave the jury improper instructions on the scope of property under the federal wire fraud statute. While this clarified the legal definition of property in that specific context, it potentially makes it harder for the government to prosecute insider trading for digital assets that are not considered securities.
So if an NFT isn't a security, using wire fraud laws becomes trickier.
Potentially, yes. It highlights that ongoing challenge of fitting new digital asset types into old legal boxes, especially when they don't neatly fit the security definition. It creates a gap that really needs clearer rules, underscoring the urgency for comprehensive legislation.
Fascinating. Adding another layer here is the rise of these event contracts or prediction markets.
Yeah, this area is really heating up.
So simply put, these are financial derivatives where the payoff depends on some future event happening, right?
Exactly. Traditionally used for hedging financial risks, but recently there's been this trend towards using them for more speculative predictions, election outcomes, sports results, things like that.
And this clashed with regulators initially.
It did, particularly with Kalshi. But then came the Kalshi LLC v. Commodity Futures Trading Commission decision in September 2024. The court basically ruled that political election predictions did not automatically count as gaming under the Commodity Exchange Act.
Okay, so not gambling, but a commodity contract.
According to that court ruling, yes. This opened the door for Kalshi to expand its offerings political markets, even entertainment predictions like Spotify charts or movie scores. It really pushed the boundaries, blurring lines between financial derivatives and what some states might see as gambling.
And the CFTC stance changed with the new administration.
Dramatically. The CFTC initially fought Kalshi's attempts. But then, on May 5, 2025, they dropped their appeal of that court decision. Acting Chair Caroline Pham openly criticized what she called anti-innovation policies of the past several years.
Wow, quite a statement.
Yeah. It solidified Kalshi's position. Their CEO basically declared victory, saying their approach had officially and definitively secured the future of prediction markets in America.
But it's not all clear sailing, is it? There's friction with states.
Exactly. This federal green light has created this fascinating conflict with state gaming commissions. Some states have issued cease and desist orders against Kalshi for their sports-related contracts, arguing it's unlicensed sports gambling under state law.
Ah, the classic state versus federal turf war.
Precisely. Kalshi is suing those states, arguing that federal law, the CEA, preempts state authority over these contracts. And they've had some early wins in places like Nevada and New Jersey, with courts agreeing federal law takes precedence here.
So it's a battle over who makes the rules,
Mm-hmm.
and it's pushing the definition of investing versus gambling for these new kinds of digital contracts.
It really is. And the outcome will have big implications.
Okay, so if we tie all this together, these cases, the enforcement against Kraken and Nuki DAO, the SEC's shift on Coinbase and NFTs, the court fights over Kalshi, they all seem to scream one thing.
Yeah.
We need clear federal rules.
Absolutely.
The White House report and these new sprints seem like a direct response to that chaos.
Yeah.
It wasn't just about individual cases. It was like the whole system sending distress signals.
That's a perfect way to put it. The existing frameworks were being stretched, twisted, challenged. It created immense uncertainty. Totally unsustainable. Think back to that analogy. The different chefs in the kitchen with no shared recipe book.
Right, chaos in the kitchen.
Exactly. Some making great stuff, others burning things, total confusion over who controls the oven or even what ingredients are allowed. These notable cases were the moments the kitchen realized it desperately needed a head chef and a clear set of instructions for everyone.
Instead of just letting everyone improvise and hope for the best.
Precisely. It's a deliberate move towards order and predictability, moving from that chaotic free-for-all to, hopefully, a well-run culinary institution, fostering quality and safety.
Okay, so with that crucial history set, and the SEC also signaling this big shift, let's dive into the real core here. What the CFTC is actually doing right now to spearhead this transformation. It's not just talk anymore. They are in full sprint mode. Acting Chairman Caroline Pham kicked off this crypto sprint on August 1st, 2025, specifically to implement those recommendations from the President's Working Group report. And she really underscored the urgency, saying the CFTC is wasting no time fulfilling the vision to make America the crypto capital, and explicitly mentioned working closely with the SEC's new leadership.
Yeah, that coordination piece is key.
It really highlights the high-level effort underway.
And the first major initiative under the sprint dropped just 3 days later, August 4th. And it's a potential game changer. The CFTC launched an initiative to allow trading of spot crypto asset contracts on CFTC-registered futures exchanges, those designated contract markets, or DCMs.
Spot crypto on futures exchanges. That is groundbreaking. Why is that so significant?
Well, two main reasons. First, it aims to provide much-needed regulatory clarity for listing spot crypto assets. Just defining the path is huge. Second, it enables immediate trading of digital assets at the federal level on venues that are already well-established, regulated, and used to handling large, complex financial products.
So bringing crypto trading onto the existing trusted infrastructure.
Essentially, yes. And the mechanism they're proposing uses their existing authority under that Section 22D of the CEA and Part 40 of their regulations. They're basically leveraging the framework they already have for certain retail commodity transactions to now bring spot crypto onto these regulated venues.
So asking, how do we safely load this new type of cargo onto our existing well-tested ship?
Exactly. And importantly, they invited stakeholders to give feedback by August 18th on how this could work, including any potential conflicts or overlaps with securities laws.
So they're asking the industry before finalizing things.
Right. It shows a pragmatic approach. They want real-world input to make sure the framework is robust and actually works.
And this isn't just a one-off thing, right? You mentioned they're tackling the whole report.
Correct. This isn't a single sprint. It's more like a marathon relay. On August 21st, Acting Chairman Pham announced the next phase, starting stakeholder engagement on all the other report recommendations relevant to the CFTC. Public input on those is open until October 20th. It signals a really comprehensive, multi-stage process. They're meticulously working through the entire White House playbook for crypto commodities.
Building the whole house, not just painting the front door.
Exactly. And beyond these specific sprint initiatives, the CFTC has been busy clearing the path in other ways. They've been actively removing obstacles by withdrawing old, potentially outdated staff advisories, like guidance on clearing digital assets and listing virtual currency derivatives, rescinded back on March 28th.
Getting rid of old roadblocks.
Yep. It signals they want to remove guidance that might seem overly cautious or restrictive under this new pro-innovation stance. They're also actively fostering innovation, putting out new guidance, holding a first-ever crypto CEO forum, talking about pilot programs, even observing industry tokenization efforts.
So engaging directly with the industry.
Very much so. Plus, they've already completed public comment periods on things like 2047 trading and perpetual derivatives, both of which have actually been trading live on DCMs since April and May this year.
Wow, so perps are already live on regulated U.S. exchanges.
Yes, under this new approach. It shows they're not just reacting, they're proactively exploring and enabling new market structures for crypto.
Okay, so the CFTC is moving fast. Meanwhile, the SEC isn't just watching from the sidelines, despite its old reputation.
Not at all. Under its new chair, Paul Atkins, Project Crypto is explicitly the SEC's North Star in supporting that crypto capital vision. It's a really significant shift from the previous administration's approach, moving away from regulation by enforcement, which, kept everyone guessing.
Right, created so much fear.
Towards a proactive regulation by framework. a deliberate effort to end the uncertainty that pushed so many projects offshore.
So what are the key goals of Project Crypto specifically?
They're ambitious. The SEC aims to create clear, practical rules for crypto asset distributions, custody, trading. This includes developing guidelines to finally distinguish between digital collectibles, commodities, stablecoins, and securities, addressing that core uncertainty.
The million-dollar question again.
Right. It also wants to facilitate onshoring of crypto businesses, modernize custody rules, enable trading of both security and non-security crypto on regulated platforms, and even support the development of super apps.
Super apps. Like one platform for everything.
That seems to be the vision. What's also noteworthy is the emphasis on accommodating DeFi and on-chain systems, encouraging innovation through exemptions for new models, and making sure rules don't stifle tech progress. It's a very different SEC tone, actively trying to build guardrails that allow innovation, not just shut it down.
And we're seeing actual results from Project Crypto already. Specific clarifications.
We are. For instance, August 5th, they issued guidance saying liquid staking activities are generally not securities offerings as long as they stay purely administrative.
That's big for staking protocols. A clear signal about what's outside SEC jurisdiction.
Huge. It reduces that fear of retroactive enforcement that hung over so many projects.
And they're also drawing lines around what isn't a security, right? Like meme coins, mining.
Yes, exactly. They've explicitly stated that certain meme coins, as of Feb 27th, proof-of-work mining activities, as of March 20th, and even specific dollar-backed stablecoins, if they maintain that stable one-to-one value and have solid liquid reserves, as clarified on April 4th, generally fall outside their securities jurisdiction.
So not just focusing on what is a security, but also what isn't.
Right. It's a deliberate act of drawing clearer boundaries, offering breathing room and certainty for foundational crypto activities and asset types that lived under that cloud of ambiguity for so long. For anyone involved in basic crypto infrastructure, that's immense relief.
What about things like ETFs, or ETPs as they call them?
Significant moves there, too. On July 29th, the SEC approved in-kind creations and redemptions for crypto ETTs, including Bitcoin and Ether. They used to be cash only.
In kind. What's the benefit there?
Think about it. Before, if a big institution wanted to create or redeem shares in a Bitcoin ETP, they often had to deal in cash. Buy Bitcoin, sell it for cash to get shares, or redeem shares, get cash, then buy Bitcoin. Extra steps, extra costs, potential tax hits.
Right, clunky.
In-kind means they can directly swap Bitcoin for ETP shares, and vice versa. Much cleaner. It cuts costs, simplifies taxes, and crucially, makes these crypto products work much more like traditional commodity funds.
Which makes them more attractive to mainstream finance.
Exactly. It's key for attracting more institutional capital. They've also approved related things like mixed Bitcoin Ether ETPs and options on some spot Bitcoin ETPs. They're integrating crypto into familiar financial plumbing. Plus, they withdrew that outdated guidance on broker-dealer custody back in May, further aligning with this push for a clearer, more enabling environment.
Okay, so the agencies are sprinting, but Congress hasn't been idle either. You mentioned the Genius Act.
Yes, this is truly monumental. The Guiding and Establishing National Innovation for U.S. Stablecoins, or Genius Act, was signed into law by President Trump on July 18, 2025. Why monumental? It's the first comprehensive federal regulatory framework for payment stablecoins. Finally brings clarity and stability to this absolutely critical part of the digital asset market.
Regulated digital dollars, basically.
That's the goal. And the act sets out clear core requirements.
Like what?
First, 100% reserve backing with highly liquid assets, U.S. dollars, or short-term treasuries. No more unbacked or algorithmically backed chaos. Ensures every stablecoin is genuinely backed, reducing run risk.
Okay, solid backing. What else?
Transparency. Monthly public disclosures of reserve composition makes them auditable. Also defines permitted payment stablecoin issuers, subsidiaries of insured banks, or federally state-licensed non-bank entities. Brings institutional credibility.
And consumer protection.
Strict marketing rules, no claiming FDIC insurance or legal tender status. Prevents confusion. Plus, stablecoin holders get priority in an insolvency, like bank depositors, a strong safety net. And finally, critically, it explicitly brings issuers under the Bank Secrecy Act. That means robust AML CFT compliance KYC procedures.
Know your customer.
Right. And even the technical ability to seize, freeze, or burn stablecoins if lawfully required. It's a robust framework aiming for confidence, preventing illicit use, and integrating stablecoins properly.
Sounds comprehensive. But you mentioned not everyone's thrilled. Bankers have concerns.
Yeah, some bankers associations are pushing back on perceived loopholes. For instance, the ban on paying interest on stablecoins doesn't apply to brokers, dealers, exchanges, or their affiliates.
Ah, so Circle or Tether can't pay interest, but maybe Coinbase could on USDC held there.
Potentially, yes. The bankers worry this creates an uneven playing field, maybe pulling deposits away from traditional banks into these interest-bearing stablecoin accounts held elsewhere. They also want states to have more power over out-of-state institutions and are pushing to block non-financial companies from issuing stablecoins altogether, citing risks to the separation of banking and commerce.
So ongoing debate about leveling the playing field and potential unintended consequences.
Exactly. It highlights the tension as new tech emerges.
With the CFTC, SEC, and Congress all making big moves, how are other regulators reacting to this seismic shift? Are they getting on board?
Overwhelmingly, yes. We're seeing adjustments across the financial regulatory landscape, signaling a broad institutional embrace. The Federal Reserve, for instance, announced on August 15th it's sunsetting its special Novel Activities Supervision Program. Crypto activities will now just be part of normal bank supervision.
So treating crypto banking as just banking.
Pretty much. No longer this weird, separate, experimental thing. They're also rescinding earlier restrictive guidance and, interestingly, removed reputational risk as a formal part of bank supervision back in June. Seems like a more hands-off approach for lawful crypto activities. Similarly, the Office of the Comptroller of the Currency, the OCC, reaffirmed banks can engage in crypto custody, execution services, stablecoin activities. They rescinded that restrictive Biden-era interpretive letter 1179.
So clearing the path for banks to get involved.
Yes, providing critical clarity for traditional financial institutions. And FinCEN, the Financial Crimes Enforcement Network, has been incredibly active too.
What are they up to?
Convened a public-private partnership on August 6th to promote innovation while tackling fraud risks. Issued warnings on August 4th about illicit use of crypto ATMs or kiosks.
Right, the ones you see in convenience stores sometimes.
Exactly, citing their use in scams, fraud, money laundering. And crucially, FinCEN is also seeking public input, as required by the Genius Act, on innovative ways to detect and stop illicit digital asset activity.
So balancing innovation with security.
That's the tightrope. Even the Department of Labor, the DOL, changed its tune. Remember that 2022 guidance warning 401k plans against crypto?
Yeah, that caused a stir.
They rescinded it on May 28th. They're back to a neutral stance, saying the old extreme care standard wasn't actually in the law.
Meaning 401ks can consider crypto now.
Fiduciaries can evaluate crypto options using the same prudent investor standards as any other asset. It potentially opens up a massive new avenue for mainstream adoption via retirement funds.
Wow. And Fannie Mae, Freddie Mac too.
Yeah, a surprising one. On June 26th, they were ordered to prepare to count crypto as an asset for mortgage applications, provided it's held on a U.S.-regulated centralized exchange.
Crypto helping you buy a house.
Yeah.
Who would have thought?
Right. These collective actions across all these agencies show a broad, coordinated push to bring digital assets into the mainstream financial system under a new, clearer regulatory umbrella. It fundamentally reshapes how they're seen and used.
Okay, all these changes are moving crypto forward incredibly fast. But they also bring new, very practical challenges. Like, if we're seriously talking about bringing spot crypto trading onto exchanges originally designed for derivatives, how will that actually work on a technical level? What are the specific technical and operational hurdles for these DCMs to integrate spot crypto trading while keeping markets fair and customers safe? This feels like our second big knowledge gap for you to consider, because the answer here really shapes how this vision gets executed. How do you even start merging these two different worlds?
That is a profoundly important question, and yeah, the technical lift is non-trivial. First off, DCMs run on these highly optimized, super low latency trading systems built for derivatives. They have very specific settlement and clearing mechanisms.
Right, futures settle differently than buying actual Bitcoin.
Exactly. Spot crypto involves immediate delivery, different custody needs. Merging those demands means significant back-end work. They either have to adapt their existing infrastructure or build entirely new modules to handle crypto's unique features, especially around direct ownership, on-chain transfers, things like that.
Okay, so the plumbing needs an upgrade. What else?
Then there's the operational challenge of 247 trading. Traditional markets have opening and closing bells.
Crypto never sleeps.
Right. DCMs would need to adapt their market surveillance, their risk management, their customer support to run continuously round the clock. That's a major operational shift. And then there's security and custody. We're talking potentially huge volumes of spot crypto. DCMs have robust security for dollars and traditional assets, but securing digital assets needs specialized expertise, cryptography, cold storage, multi-sig wallets.
Different skill set.
Totally. They'll also need to integrate with a whole range of crypto liquidity providers and ensure robust KYC/AML protocols are applied consistently to spot trades, which can look different from derivatives trades. It's a really complex dance, adapting existing strong frameworks to a fundamentally different asset class, all while maintaining those high standards of integrity and protection expected of federally regulated exchanges.
So yeah, definitely not just flipping a switch. It's designing a whole new operational workflow, 24/7 surveillance, new clearing processes, ensuring customer protection for potentially volatile digital assets. That's a massive undertaking. Really highlights the scale of this overhaul. Okay, so with all these rapid changes, let's look ahead. What does this all mean for the crypto ecosystem? Which parts stand to win big, and what the CFTC acting chairman has called this emerging golden age of crypto?
Well, what's really compelling is that the initial beneficiaries are likely the big guys, the major crypto assets already comfortable within existing regulatory rails. Bitcoin and Ethereum are, without doubt, the initial winners. They already have established futures markets on CFTC-supervised exchanges like the CME, with significant trading volume.
So adding spot trading for them is a relatively smaller leap.
Exactly. Adding spot contracts to those same venues creates a path with minimal friction from a regulatory standpoint. It gives them a clear, federally regulated onshore market for spot trading that just didn't exist before in the same way. And beyond them, leading altcoins like Solana and XRP, which also already have regulated futures products live, could see an even more significant relative impact.
Why more significant for them?
While their futures volume hasn't matched Bitcoin or Ethereum, having CFTC-registered spot listings could have an outsized positive effect. For these somewhat smaller market cap assets, even modest additional spot buying pressure and institutional interest could potentially move prices substantially higher. This regulatory clarity provides that clear, legitimate on-ramp for U.S. institutions that was previously murky or missing entirely. It fundamentally de-risks participation for them.
And it's not just about the coins themselves winning, right? This is going to shake up the market structure where trading happens.
Absolutely. U.S. venues that can list these assets under clear CFTC oversight stand to gain significant market share. We could definitely see a shift where offshore platforms may lose ground as more trading shifts to regulated onshore infrastructure.
Which sounds like exactly what the administration wants.
It's almost certainly a deliberate strategy. Repatriate crypto activity, talent, capital back to the U.S., cementing its position as a global leader.
And this clarity should bring in the big money. The institutions.
That's the expectation. Stronger customer protections, better market surveillance, auditable rails, all hallmarks of CFTC oversight make it much, much easier for large institutions to justify getting involved. We could see significantly deeper liquidity flowing into U.S. venues, making our crypto markets more robust, more mature, maybe less susceptible to those wild swings we saw in the early, less regulated days.
So making crypto palatable for the hedge funds, asset managers, pension funds.
The trillion-dollar players who've mostly been watching from the sidelines because of the regulatory fog, now they have a clearer, safer pathway in.
This clearer environment also opens the door for more sophisticated trading strategies, right? You mentioned basis trading.
Yes.
Remind us again, this is profiting from the price difference between spot and futures. How does it work? And why is it important now?
So basis trading involves simultaneously buying an asset on the spot market and selling short its corresponding futures contract. The goal is to capture that price difference, the basis, as it converges over time. For example, a pro trader might buy Bitcoin on a newly CFTC-regulated spot market and at the same time sell a Bitcoin futures contract on the CME.
Okay.
This new framework, allowing listed spot crypto on DCMs alongside futures, makes this strategy much more efficient and accessible, especially in crypto where these price gaps can be pretty significant, particularly with altcoins. But what's really crucial to understand here is that this type of trading technically doesn't create any net new demand for the underlying asset itself.
Because you're buying spot but selling futures. Net neutral.
Exactly. While it adds to trading volume and liquidity, making markets more efficient through arbitrage, it's a net neutral price impact from this specific trade type. It's a sophisticated strategy that thrives in regulated interconnected markets, a sign of market maturity.
Got it. Another big development you mentioned was the CFTC greenlighting perpetual futures on regulated exchanges. That could really shake things up for U.S. traders.
Oh, absolutely. Think about the current situation for perpetuals, or perps.
Mm.
Many U.S. traders access these highly leveraged products on decentralized exchanges, DXs, often using VPNs to get around geographic blocks.
So operating in a regulatory gray zone, basically.
Or sometimes an outright illegal one, frankly, and taking on potentially huge unmitigated risks. Now, with a legal regulated framework for perps emerging on centralized exchanges, ECXs, offering stronger security, more transparency, real safeguards under CFTC oversight.
Traders might prefer the safer option.
You'd expect a significant migration. Why operate in the shadows with DX risks when you can trade regulated perps on a major CEX? It would bring a huge chunk of currently opaque trading activity onto regulated, surveilled platforms.
Increasing transparency, protecting users, and probably boosting volumes for U.S. exchanges.
Exactly. It's a move from the shadows into the light. Now, while the outlook seems largely positive, signaling this new era, we have to acknowledge some gray areas remain.
Right.
Especially around that jurisdictional overlap. The dance between the CFTC and SEC and even federal versus state governments means not everything is perfectly settled just yet.
The Wild West might have new sheriffs, but
Yeah.
some territories are still disputed.
That's a good way to put it. One persistent challenge is what some people call the morphing asset problem.
Morphing assets.
Yeah, tokens that may be launched like securities through an ICO, for example, but now because they're so decentralized, widely used, or have clear utility, they function much more like non-securities, like commodities.
Ah, like maybe Ethereum could be argued that way.
That's often the poster child for this argument. The White House report actually acknowledges this issue and urges the SEC to allow these kinds of tokens to trade on non-SEC platforms after their initial sale, provided proper safeguards are in place. If the SEC actually follows through on that, it would remove a massive source of uncertainty for exchanges and traders dealing with assets that evolve over time. It's a really tough line to draw.
Definitely. And the White House also called for a unified trading framework, allowing one platform to offer everything.
Yes, that vision of super apps or integrated platforms. Imagine one place to handle your stocks, bonds, crypto trading, savings, loans,
Right.
all under one regulatory roof.
That would be simpler.
Hugely simpler for compliance and for users,
Yeah.
collapsing the current fragmentation. But the specifics of how to do that, reconciling the different SEC and CFTC roles on one venue, that's still being worked out. And remember the state friction, too. Even with federal approval for things like event contracts, as we saw with Kalshi, states can still challenge them, creating this complex, multi-layered regulatory environment.
So, lots of progress, but still some hurdles. Given this incredible momentum, though, when can we actually expect all this to be fully implemented? When will we see the real impact? What are the timelines, and what should we, the listeners, be watching for most closely?
Yeah, there isn't like a single completion date on the calendar. It's going to be gradual with multiple announcements and stages. Think of it like building a huge complex city. It happens neighborhood by neighborhood. The CFTC's initial comment window for that spot listing initiative just closed on August 18th. Once they digest that feedback, they can move forward using their existing tools pretty quickly. So we could see exchanges starting to self-certify new spot listings relatively soon.
So watch for those filings from exchanges like CME or others.
Definitely. Similarly, the SEC is expected to roll out changes for Project Crypto gradually over the coming months and quarters, but hopefully with clear, consistent guidance now. What's really important here is the clear roadmap they seem to have now and the executive backing. That provides a strong push for these agencies to act relatively quickly and with a unified purpose. The momentum is real and building fast.
So for you listening, the key things to monitor are: watch for the public comments on the CFTC's spot listing plan. They'll be posted publicly and can give clues. Then watch for those actual filings from exchanges as they self-certify spot products. That's where the rubber hits the road. And keep an eye out for ongoing updates from both the CFTC and SEC as they keep rolling out guidance under their respective sprints and projects. The pace is unprecedented. Staying informed is crucial. Okay, final big picture question. If this golden age of crypto really does unfold as planned, with all this regulatory clarity and institutional buy-in, what long-term impact could it have on the traditional financial system? And maybe more importantly, how might that affect everyday financial services for you, the average consumer or investor? This is our third knowledge gap, and it brings up some really fascinating possibilities. What are some ways you see this playing out?
That is the profound question, isn't it? And maybe one of the biggest unknowns. Long term, we could see a much more integrated financial system. For the average consumer, this might mean digital assets become less of a niche speculative thing and more of a seamless part of everyday finance. Imagine using a regulated stablecoin for instant international payments with almost no fees. Or having crypto-backed lending options that are transparent, compliant, less risky.
Crypto becoming
Mm,
normal.
Kinda, yeah.
Yeah.
Your retirement account might eventually offer crypto exposure as a standard, prudently managed asset class, not just some wild venture.
Right.
But this integration also raises questions about privacy and control.
The trade-offs.
Exactly. While it offers convenience and security, it also means traditional financial oversight surveillance. Reporting extends more deeply into digital asset ownership. For investors, it could mean more diversified portfolios, easier access to global digital markets, but perhaps with less of that crazy 100x upside potential that characterized the early unregulated days.
So the Wild West field diminishes.
It inevitably does, replaced by something more like a modern, regulated financial metropolis. The trade-off is often between freedom and security, maybe innovation speed versus stability. And this new era is definitely leaning into stability and security, promising a more predictable, but perhaps less adventurous financial future for digital assets. Hashtag outro. So what we've really seen today is this fundamental pivot in U.S. crypto regulation. It feels like we're shifting from a fragmented, uncertain exchange-by-exchange set of rules, where every new product felt like a potential legal battle,
Right.
to a more cohesive exchange class approach. If the CFTC's plan sticks and works hand-in-hand with the SEC's Project Crypto, spot crypto could soon look and feel much more like other regulated markets, standardized, surveilled, ready for wider participation. And underneath it all, the Genius Act provides those compliant, robust dollar rails with regulated stablecoins, offering a stable foundation. It's about building a legitimate financial base within the existing architecture.
It really is a rapid upgrade to the U.S. crypto trading infrastructure. Could fundamentally reshape the industry's future in the coming months and years. This isn't just tinkering, it feels like a structural overhaul, designed to position the U.S. as the leader, moving from that chaotic frontier to a more ordered, dynamic digital economy. But this shift from that fragmented, often unregulated landscape to one of structured clarity, institutional oversight, it could lead to a far more integrated, robust, and maybe boring financial system.
Boring might be the goal for some.
Is boring exactly what crypto needs to become truly mainstream? And what might we gain or lose in that transition? It's a provocative thought, right? It challenges that early rebellious crypto ethos. We definitely encourage you to think about how these regulatory developments impact your own understanding of digital assets and how they might shape your future financial decisions. Keep exploring, keep questioning, and keep learning.